Hey everyone, welcome back to Corporate Decoder, the place where we dissect the financial world's secrets. And today we're diving into Pioneer Power Solutions Incorporated's latest 10Q filing, a document packed with numbers that tell a story of their recent performance and future outlook. Get ready for some serious market insights, you do not want to miss this. Before we jump in, if you love getting these clear, concise breakdowns of complex financial documents, hit that subscribe button and ring the bell. Also, we have a fantastic community over on Discord, all linked in the description below, where we discuss these findings and more. So what are we looking at here? This is Pioneer Power Solutions Inc.'s quarterly report for the period ending the 30th of September 2025. It is essentially their financial checkup telling us how they've been doing and what they expect moving forward. Pioneer Power Solutions is in the business of designing, manufacturing, and integrating distributed energy resources, power generation equipment, and mobile electric vehicle charging solutions. Think of them as a player in clean energy and reliable power infrastructure. Let's get straight to the numbers, the heart of any financial report. We're looking at their operations for the third quarter and the first 9 months of 2025 compared to 2024. First up, revenue. For the 3 months ended the 30th of September 2025, their total revenue was $6,888,000. That is up from $6,416,000 in the same period of 2024, a modest increase of about 7.4%. Now, looking at the bigger picture for the 9 months ended the 30th of September 2025, revenue jumped significantly to $21,998,000, up from $13,126,000 in 2024. This is a massive 67.6% increase. What drove this big growth that seems to be a combination of sales and rentals of their mobile EV charging solutions called eBoost and an increase in service sales? That is a really positive sign showing strong demand for their new products. But what about profitability after selling their goods? Pioneer Power Solutions had a gross profit of $640,000 for the third quarter of 2025. This is down substantially from $1,522,000 in the same quarter of 2024. Their gross margin also dropped from 23.7% to just 9.3%. That is a significant hit. For the first 9 months of the year, gross profit also fell from $2,698,000 in 2024 to $2,102,000 in 2025. Their margin slipped from 20.6% to 9.6%. This big drop in gross profit and margin is a concern. The report mentions an unfavorable sales mix. This means they might be selling more of their lower margin products or facing higher costs for the products they are selling. They also point to a specific contract in their Pioneer e-mobility business that had lower margins initially due to higher production costs as they refined their processes. This suggests there might be some growing pains with scaling up new product lines. Moving down the income statement, we see operating expenses. For the 3 months ended the 30th of September 2025, these were $2,087,000. That is a decrease from $2,236,000 in 2024. Selling, general, and administrative expenses saw a slight decrease of about 0.2% to $1,976,000. As a percentage of revenue though, these expenses actually went down because revenue increased. This is good. They are becoming more efficient with their overhead relative to their sales. Research and development expenses also decreased significantly from $256,000 to $111,000 for the quarter. For the 9 months, R&D spending was similar year over year. This could indicate that they are focusing more on sales and marketing of existing products rather than new development, or perhaps they have completed some major R&D milestones. Now, as a result of these revenues and expenses, we look at the operating loss from continuing operations. For the third quarter of 2025, the operating loss was $1,447,000. This is a bigger loss than the $714,000 in the prior year's quarter. And for the first 9 months of 2025, the operating loss expanded to $5,502,000 from $4,175,000 in 2024. This widening loss, despite significant revenue growth, is directly tied to that lower gross profit we discussed earlier. On the other side of operations, they reported interest income in 2025, which is a good sign. For the third quarter, it was $184,000 compared to interest expense in 2024. This is likely due to their increased cash balance from the sale of a subsidiary. Other expenses notably include a $438,000 loss in the third quarter of 2025 from their equity method investment. This investment is likely related to the sale of their electrical infrastructure business. So after all that, the bottom line, a net loss. For the 3 months ended the 30th of September 2025, Pioneer Power Solutions reported a net loss of $2,350,000. That is a considerable loss compared to $1,121,000 in the same period of 2024. And for the 9 months ended the 30th of September 2025, the net loss was $4,607,000 compared to a nearly identical loss of $4,439,000 in 2024. So while revenue grew significantly, the company is currently losing more money in its core operations. Let's switch gears and look at their balance sheet. This gives us a snapshot of what they own and what they owe at a specific point in time. As of the 30th of September 2025, total assets were $37,580,000. This is down from $65,951,000 at the end of 2024. A big reason for this decrease is likely related to the cash they used for a significant dividend payment. Cash on hand was $17,336,000 as of the 30th of September 2025. This is down from $41,622,000 at the end of 2024. The report mentions this cash was primarily generated from the sale of their former subsidiary Pioneer Custom Electrical Products Corp, or PCEP. They also paid a substantial dividend of $16,665,000 in January 2025, which explains the reduction in cash. Accounts receivable net stands at $4,606,000, down from $7,826,000. This indicates a reduction in money owed to them by customers, which is generally a positive for cash flow. Inventories increased slightly to $6,780,000 from $6,068,000. This could suggest they are building up stock potentially in anticipation of higher future sales. On the liabilities side, current liabilities are much lower at $6,281,000 compared to $29,978,000 a year ago. This is a very positive development, showing they have significantly reduced their short-term obligations. Total liabilities are now $6,881,000, down from $30,522,000. This is a dramatic improvement, reducing their overall debt burden considerably. Stockholders' equity is $30,699,000, down from $35,429,000. This decrease is mainly due to the accumulated deficit, which reflects the net losses incurred by the company. Looking at stock-based compensation, the expense for the first 9 months of 2025 was $25,000 compared to $334,000 in 2024. This is a significant reduction in non-cash compensation expense. Now let's touch on discontinued operations. Pioneer Power Solutions sold its electrical infrastructure segment, the PCEP business unit, in October 2024. This means the financial results from that part of the business are reported separately. For the 9 months ended the 30th of September 2025, they actually had an income of $467,000 from discontinued operations. This income was mostly due to finalizing a net working capital adjustment from that sale. This sale has clearly simplified their business structure. They now operate under a single reportable segment, Critical Power Solutions. This segment focuses on mobile EV charging solutions and power generation equipment. Geographically, their revenues are primarily from the United States, with a small portion coming from Canada. The US still dominates their sales. Their reliance on a few large customers remains a risk. For the 3 months ended the 30th of September 2025, 2 customers accounted for 19% and 17% of their revenue respectively. While this is much lower than the 45% and 10% in the prior year's quarter, it still shows a concentrated customer base. For the first 9 months of 2025, 1 customer represented a substantial 30% of revenue. This concentration means that losing even one of these key clients could significantly impact their financial performance. In their Critical Power Solutions segment, equipment revenue was relatively flat for the quarter, but service revenue increased by 19%. For the 9-month period, both equipment and service revenues saw substantial increases, with equipment revenue nearly doubling. This growth in equipment sales, especially for their Boost EV charging solutions, is a positive indicator of market adoption. But again, that margin pressure is evident. The gross margin for Critical Power Solutions dropped from 23.7% to 9.3% for the quarter, and from 20.6% to 9.6% for the 9 months. As mentioned, this is influenced by product mix and initial production costs for new products. Selling, general and administrative expenses for the 9 months increased by 11.5%. This rise is attributed to higher payroll, trade show costs, and insurance. However, as a percentage of revenue, these expenses decreased significantly due to the overall revenue increase, which is a good sign of operational leverage. These factors combined led to a larger operating loss from continuing operations for both the quarter and the 9-month period. The loss widened from $714,000 to $1,447,000 for the quarter and from $4,175,000 to $5,502,000 for the 9 months. On the tax front, Pioneer Power Solutions recorded an income tax expense of $69,000 for the 9 months of 2025. This might seem odd given their losses, but it is related to a return to provision adjustment for prior year estimates and the fact that they maintain a full valuation allowance on their deferred tax assets. Essentially, they can't currently take advantage of tax benefits from their losses. Let's talk about liquidity and where they stand financially. As of the 30th of September 2025, they had $17,336,000 in cash. This is down from the end of 2024, mainly due to that large dividend payment. Cash used in operating activities was $4,780,000 for the 9 months of 2025. This is a slight increase in cash outflow compared to 2024. The report cites working capital fluctuations and tax payments as reasons for this. Investing activities show a significant outflow of $2,751,000 for the 9 months of 2025 compared to $1,277,000 in 2024. This increase is largely due to the final payment related to the PCAP sale and capital expenditures on property and equipment. Score financing activities show a large cash outflow of $16,755,000 in 2025 compared to a net inflow in 2024. This is primarily because of that substantial dividend payment made in January 2025. Working capital as of the 30th of September 2025 was $22,766,000, including that cash on hand. This is down from $26,679,000 at the end of 2024, but still a healthy figure indicating they can cover their short-term obligations. An important note here, management concluded that their disclosure controls and procedures were not effective as of the 30th of September 2025. This is due to a material weakness in internal control over financial reporting, specifically a lack of sufficient accounting personnel causing improper segregation of duties. They have a plan to fix this by hiring more staff, implementing a new ERP system, and enhancing controls. This is a common challenge for growing companies, but it is something investors should keep an eye on. Now, for the risks, the company reiterates its reliance on a few key customers. As we saw with the revenue concentration, this is a significant risk. Losing business from these major clients could really hurt their financial performance. They're also facing broad economic risks like inflation and geopolitical developments, which could impact demand for their products and services. This material weakness in internal controls is flagged as a risk investors need to be aware of. While they have a remediation plan, it will take time to implement and prove effective. So what is my take on Pioneer Power Solutions Incorporated? Based on this filing, the company is experiencing significant top-line growth driven by its Boost Mobile EV charging solutions and its critical power segment. That is a strong positive sign showing market traction. However, this growth is coming at a cost. The declining gross margins and widening operating losses are concerning, indicating that efficiently scaling production and managing costs, especially for new product lines, is their biggest challenge right now. The sale of their PCRP business has simplified their operations and improved their balance sheet by reducing debt, which is good. But the material weakness in internal controls cannot be ignored and needs diligent management attention to ensure accurate financial reporting going forward. Their heavy reliance on a few major customers also presents a substantial ongoing risk. Overall, Pioneer Power Solutions is in a growth phase with promising new products, but they need to prove they can translate that revenue growth into sustainable profitability and strengthen their internal controls. The market for EV charging and critical power solutions is undoubtedly growing, and Pioneer is positioned to capture some of that growth, but execution will be key. Alright, that is our deep dive into Pioneer Power Solutions Incorporated's latest 10Q. What do you think about these numbers and their future trajectory? Do you see the growth in EV solutions as a major win, or do the margin issues and control weaknesses outweigh? Let me know your thoughts in the comments. If you found this breakdown valuable, give this video a thumbs up. It truly helps us out, and subscribe if you want more of these financial dissections. And don't forget to join the conversation on our Discord community linked in the description. Thanks for watching, and until next time, stay informed.